Hey folks, I'd like to thank everybody for attending our webinar today. My name is Brian Weaver. I'm the VP of Sales at NSA, and this is our professional services webinar number 62 with Avalara. Avalara is basically the solution for Infor SXE and Cloud Suite in the distribution space, and one of our longest term partners. And very pleased to have the Avalara team with us. And with this, I will go ahead and turn it over to you, Andy.
Yeah, sure. Thanks, Brian. And I appreciate everybody joining the call. Just a quick disclaimer. We hope you find this discussion very helpful, but at the same time, please know that this should not be used for any legal or tax advice because we are a software company. We do leverage the software. So just wanted to give that disclaimer there. And then, so just to introduce myself real quick, my name is Andy Hall. I'm one of our account executives here at Avalara. I've been in SaaS for 10 years now, and then working within tax compliance software for the last 6. 3 of those have been here at Avalara. I've gotten to know the great group at NSA through conferences and working with mutual clients to really kind of solve any tax complexity needs that come up during the conversations. And a little bit about myself. I'm here in Atlanta, Georgia with my wife. I've got 3 girls, twins, 3.5, and then a young one that just turned 1, and then 3 dogs as well. So hopefully no one knocks on the door during this webinar, because if not, all 3 of them will follow each other and start barking. So Brian, I'll turn it over to you.
Hey, thanks. I'm Brian Smith. I'm spent my career 33 years with incubation, which turned out to be somewhat successful. Retired and loved tech so much, I went back to work with a company that I used during my career because I trusted them. And I spent my career not so much in software, but in technology, cutting edge technology. So it's fun to see the laws catching up. I am a senior government affairs representative for Avalara. So I listen to a lot of legislators speak about new tax laws and typically keep my pulse on what's going on around the country. So, as you're out there practicing your trade, everyone else in government is trying to figure out how to make taxes more complicated. And so what we bring to you are solutions that resolve all those issues in the background so that you don't have to worry about it. What that means is that when you put an address on a shipping label and it's headed out the door, that your systems are actually going through the process of evaluating all the tax questions and answers to ensure that you have everything calculated correctly for an invoice going out to your customer. And we're going to look at some of the steps involved in doing that. You can kind of boil it down to about 5 things you need to take care of. We can speak to how we think the best way and have demonstrated through our practice the best way to solve those problems. And so just excited to be here. And I'll just kind of start speaking to this, what the trends are, and a little bit of what's happened at this point in the year. We're in July. All the heavy legislative activity kind of begins in the fourth quarter. You see states prepping what they're going to push through the legislature. Most bills have gone through the legislature. There are about 10 states that still have legislative sessions that are year-round. Typically the big states, but some of the smaller states have very short windows, or maybe they only meet every other year. So what we're seeing, though, is a definite trend of tax policy catching up with technology, meaning sales tax was designed to tax goods and services, more goods than services. As we all know, we've become a service industry. We've offshored a lot of the production activity. And so states are reforming their laws to catch those items as part of a base broadening effort that we see going across the state. So technologies that previously weren't taxed, services that previously weren't taxed, are now coming into the purview of departments of revenue, and they're looking at their budget saying, our tax code's antiquated, we're going to update. And where we've really seen kind of a controversial swing in this is advertisement of digital goods and services. So what they're trying to do is capture all the ads, we need to think of them as pop-up ads. Way back in the day when AOL was there, you'd have those boxes along the side. It's basically the same thing. It's much more elegant now with advertisements going, and they are looking to expand their definitions of what is subject to tax to include anything digital. So digital services and how the laws are being expanded. Companies that collect your information and turn around and sell that information to advertising companies, that revenue stream that we really don't see, states are going after that in a very aggressive manner. So anytime there is digital property that you're transferring and receiving some type of consideration, whether it's a credit on a future purchase or whether it's direct financial payment, the states are going after what typically used to be considered intangibles and beginning to tax those items. So we really are in step 2 of a process. If you think about 5 years ago when Wayfair passed, they drastically changed the nexus requirements, and Andy will kind of speak to that a little bit later. They become much more complex. It used to be fairly easy. But now, with the change of going after anything digital that you have out there, whether it's advertising or you're selling a service that is not tangible at all, it's digital, the states are looking to expand their base to capture that. One reason is not as many tangible goods out there, but there's also a wave of states using tax policy to incent economic development or economic migration of workers, and they're lowering their income tax. And when you think of this is a pretty closed universe of tax revenue. If you lower your income tax in a state, you need to replace that. And they found that if they expand their sales tax base, they're gonna replace that and then some in some cases. So we've seen that in Virginia. We see that in West Virginia, and the big states that have gone after consumer data or commercial data collector information are Illinois had a bill this year, New York had a bill this year, Massachusetts had a bill. All 3 of those bills ran into problems, so everybody took a deep breath. But those with legislative activity, those will be back. So think about in your business, if you're capturing information about your customers and turning it around and providing it and getting some form of consideration, think about it's not taxable now, but when it does become taxable, you'll probably have about 3 months to implement system changes to capture that. So if you're doing it, think about changing your systems or at least being able to collect that data now. And Tennessee, California, Maryland, and New Mexico, all of these digital taxes are on everybody's plate, including the streamlined sales tax states. The unique thing about streamlined sales tax states, for those of you who aren't familiar, it's about 22 states. They've joined a compact that has a goal of making collection and remittance of sales tax easy for taxpayers. And they have very rigid definitions of what is taxable and what is included within a definition. So they have taken up the task of, on a somewhat of a national scale, trying to figure out what should be included in a definition of digital codes. If you send somebody a code that allows them to go out to a large retailer like Amazon and put that code in, at the time you acquired that code and made a payment to get it, you're not sure how they're going to use it. You're going to gift that to somebody, or potentially you're going to use it downstream. And I don't know whether when I sell it to you, if I'm selling you something that's going to be used to purchase household good, a food product, a digital recording, a movie. And so they're trying to put in place guardrails to make it easy to comply and easy to collect. And that's never an easy, that's a pretty inclusive goal. And so it takes a year or two for these national organizations to figure this out. The Federation of Tax Administrators is also looking at this, and the Multi-State Tax Commission. The nice thing is they're all participating jointly and trying to keep their definitions moving forward and consistent. But those are areas you're going to see big changes in. So any services that you provide that are not subject to tax, you're going to want to keep your eyes open, because services is always a easy area for states to expand into, and it brings in a lot of additional revenue. So we just talked about services, and one of those services is the real convenient delivery fee that comes with pretty much anything you order these days in the state of Colorado or Minnesota. It's going to get an additional charge, a tax associated with the delivery of that to your home. And here, that's a service. That's a pure service, pretty much. And what happened is during COVID, everybody got used to this. All retailers put a mechanism in place, either through a third party or internally, to deliver product to your doorstep, deliver food. And the state saw that as a real opportunity to implement some type of charge that would allow the state to kind of increase their revenue. I don't think you can eloquently couch it. It's a grab. It's a revenue grab, but it happened in Colorado first. It is very difficult to implement in your system because of limitations. As you can see in Minnesota, there's a dollar value threshold. As we all know, trying to program a dollar value threshold into your tax system creates its own challenges. And probably even more difficult is when you go to enumerate that on a customer's invoice. If you have to create and distinguish that as a separate line item on an invoice that isn't subject to sales tax, but it needs to be presented. Again, more challenges that take a hot minute to get into your billing systems. So again, start thinking about that. If you're putting in system changes, sometimes you might want to start to build this out and just edit it out of your code. So it's there, you just have to tweak it. But things to think about, because it is a growing trend. We've seen 3 other states kind of dabble in the idea or have study committees to look at that. And this is probably important to you because, you probably do a lot of deliveries, whether they're within your state or they cross state lines. When it comes to these fees, if you're shipping into 30 states, you're probably going to bump up against these before the guy in the county next to you who only ships in a 50-mile radius. Something to think about, but it is a trend we're seeing. Again, let's tax the service, and so keep your eyes open.
So, Brian, just real quick on that piece, real quick. So obviously in communications or conversations with clients, freight comes up quite a bit. So this is different than freight, right? You're saying these are extra fees being added onto, I guess, invoices. Okay.
Yeah, correct. It's freight as it's designed and defined as a tax was meant to capture some of the ancillary activities that go along with providing a delivery service. It might be containers, it might be pallets that might escape the code in other places, the tax code that is. And this is more, they found that their code needs to be explicit and clear, so to stay out of the ambiguous statutes that lead to litigation. Litigation doesn't generate revenue for the state. Litigation doesn't make it easy for you to practice your business, let alone have attorneys fighting tax cases. So in addition to freight, you might see a delivery fee. Now think about it. Usually when you're shipping something, if I'm buying a large industrial appliances with the freight line item, I might run into a threshold where I bump over the dollar threshold and do not have to include that. And I think what they're trying to do is to limit this to the new services, kind of to your doorstep, couch potato services somewhat. I don't want to drive 3 miles down the street to get dinner. I'm just going to have it delivered to my doorstep. So they're trying to be specific, but they also want to cast a pretty wide net. And we can go ahead. Here, again, just that trend of expanding taxation to services. Maryland did something a little bit unconventional, meaning typically the concept with sales tax is you only want to tax the product or the service with the end user. Only tax it once. That's why we have exemption certificates. If you paper your transaction properly, you exchange exemption certificates, you're not required to collect tax until you make that ultimate sale to the end customer. Maryland jumped out and said, we're going to tax transactions, specifically those that are B2B. Wasn't extremely well received. It's a cautionary tale of what other states might try to do. The most aggressive state this session is Nebraska. The governor has what he calls the EPIC option, which is impressive. Perhaps a little hard to do, as he found out. It seeks to eliminate income and property tax, inheritance tax, and just almost, I'm not going to say it, but almost a VAT tax. They're leaning more towards a gross receipts tax like you would see in South Dakota or Hawaii, where they want to just tax every transaction to replace that income that they were generating from property, individual income tax, inheritance tax. Next slide, please.
Perfect. I think this is where I'll take over here. So
this is the fun part. Take away.
This is where it gets fun, guys. So really what I want to go over here is just really 5 steps to managing tax compliance, understanding where we have nexus, how do we get registered, what happens when we start looking at calculating sales tax, tracking of exemption certificates, and then once we get that entire process done, how do we remit the tax to the appropriate states and jurisdictions? So we've touched a little bit on the Wayfair decision, the Supreme Court ruling of 2018. If we can go to the next slide here. So the Supreme Court ruling 2018, this was basically, I always describe this as, or I tell the story of my now wife. At the time I think we were dating, might have been engaged. I don't know. It was one of those two. And she had come home, was like, yeah, Amazon's going up on their prices. And it wasn't the fact that Amazon was going up on their prices. It was the fact that this Supreme Court ruling gave states the right to impose their own sales tax obligations. And so, when we start talking about thresholds and going over, economic thresholds, what had happened was Amazon had gone over what Georgia had listed as their threshold. And so that extra fee that she was talking about wasn't a fee itself. It was just sales tax was starting to get applied to these orders. And sure enough, it did not slow down those Amazon packages. They still came. So do better, Amazon. But no, so I joked there. But Brian, I think we were talking about this earlier. Is there a lawsuit or something going on right now with Wayfair?
Yeah, so as Andy alluded to, and I'm a little bit of a dinosaur in this arena. Nexus used to be real simple. It was property, payroll, or warehouses in the jurisdiction. It was real easy. He's going to make your head spin in a minute with about 15 different things you need to consider. And that all changed when Wayfair challenged South Dakota, and it went to a much broader, much open set of rules for collecting tax. They implemented this. Everyone had to collect and remit. Just this morning, Wayfair entered in agreement. Well, it probably happened last night. Wayfair was in litigation with Lakewood, Colorado, looking for a little over $500,000 in tax from Wayfair for some prior years. The year that Wayfair went into effect, I think it was 2018, for like a 6-year period. And it's kind of been a case that went dormant for a long time. Everyone felt that Wayfair was going to lose because, Wayfair spread in the tax world like wildfire. And the city of Lakewood, Colorado, kind of put up their hands and said, we'll dismiss this case with prejudice, which means it can't be retried. And they walked away from it because the attorneys figured out that we can battle forever. Our clients lose, the state loses. There's no clarity on what is subject to tax. So it's a landscape that created a lot of litigation. It's starting to settle down a little bit, but it's important to really understand your obligations, especially once you cross a state line. I've had clients who have made a decision. They could deliver the product in their truck any day of the week, but for tax reasons, they've continued to use common carriers. And sometimes it's not only sales tax, sometimes it's franchise tax and other taxes that it might trigger. So just, maybe a little bit up the food chain for most corporations, but something to think about when you're looking at your business.
Interesting. Okay. And so we kind of talked about the economic nexus thresholds. And here's a list of basically state by state thresholds. We can see that 4 states don't have a sales tax they don't have sales tax. And then we've got different states with different thresholds. Most common being $100,000, but certainly there's the and/ors of, or 200 transactions, $100,000 and 200 transactions for states like Connecticut. And so these are really important to take into consideration too, because some of these states, I believe of these states that have these economic thresholds, 37 of these states do include exempt sales into their thresholds. And as Brian had just mentioned on one of the previous slides about services, that's another aggressive change of the law now, where it used to be in some cases where states aren't taxable or the services aren't included in these thresholds. But it looks like there's a couple states that are looking to make the move to include services into the thresholds. So if we're selling service.
One thing that we saw just in the past legislative session was North Carolina dropped the 200 retail transactions, because if you back up and you think about it, I could possibly sell 15 items a year in your state, and I could invoice $15 million. But because I didn't have 200 transactions, they might miss it. So most states are starting to drop the transaction count. It was hard to really justify. I think, again, when they write tax policy, they tend to cast a wide net and then correct it as they go to make it a little more pinpoint, a little more logical. So we are seeing most states drop the count. We're also seeing a lot of states dropping the dollar value. I think if you look 3 years out, it's the dollar, if you're making a sale in a state, you're going to have to collect.
Yeah, and that's interesting because when we move to the next slide here and we start talking about different types of nexus, obviously most people are familiar with physical nexus. Do you have warehouse inventory, employees, what have you? Economic nexus is the kind of the 2018 Wayfair ruling right there, where going off of that last slide that we just showed, where what considers or what triggers economic nexus. But then there's other kinds of nexus, and now it's got my brain churning here a little bit, Brian, because I don't know the legislative side like you do, or the legislative side of sales tax. But it sounds like the click through nexus, the affiliate nexus, and the marketplace nexus are basically just other ways to say, hey, you've got nexus in our state. So I wouldn't be surprised within the next 5 to 10 years if there's not a fiscal nexus and not an economic nexus. It's just a universal sales tax at that point, because when we start looking at marketplace facilitators, that's been a big growing trend in the industry, and so these are just other areas of nexus being explained to be aware of. So if we're doing digital ads, I think Brian talked about some digital ads a few slides ago. Those are other areas that we would want to make sure that we're not triggering uh, nexus in these states. And then when we look at nexus creating activities, this is where it really gets important, because a lot of the folks on this call, I imagine, went to the TUG conference down in Florida back in May. And so when we start looking at different types of nexus creating activities, we've got trade shows, we've got hosted data centers, we've got property, we've got maintenance, service, and repair. So and working with a lot of the NSA clients, we have maintenance plans, we have service plans, we have warranties, we have repairs. Like, those are the types of things that I think oftentimes get overlooked from being considered nexus creating activities. But then one of the most common ones that is still very much overlooked is the drop shipments. And we're doing our client a favor by shipping it directly to the end user. We're just going to go ahead and drop ship it for them. That's great, but that's also putting you at a situation where that might trigger nexus in a state. So, how do we calculate sales tax on that? Are we registered in that state to collect sales tax? Do we need to have an exemption certificate for the reseller? Like, those are the types of things that companies are now being forced to face when it comes to really kind of understanding where they have nexus obligations here. And Brian, have you seen any additional trends of kind of what's creating nexus? How are states looking at this, like drop shipments or click-throughs and trade shows? How are states looking at somebody that goes to a trade show and determining that that could be nexus creating?
Well, I'll give you a good example with a unusual type of trade show, I'll call it. And I'm sorry my camera's off. I'm going to have to make an early exit, but I'm friends with the head of the sales tax group in South Dakota, and this is coming up is the time of year where he takes 5 of his agents, and they all go up to Sturgis, and they walk around to every vendor selling products at this huge motorcycle event, and they check for licenses. And it's nice because, hey, if you don't have a license, they'll issue you one. If you're maliciously operating with ill intent, they'll just write a violation right there. So it's the landscape has changed, and the way I look at these each category, to use an old term, they're kind of like nails in the coffin. They used to try and keep you in with 3 nails, and now they have like 15 nails. So it's usually not a battle that most companies have a bankroll to fight. It can get expensive, meaning dollars followed by M. And so just be aware of all your triggers. They are very aggressive. And usually, if you look in the middle of the column on the right-hand side, investors and board members, some of their questionnaires, you're having to go to board members and get their driver's license numbers, their home address, information that board members do not like to share, as you can imagine. I wouldn't like sharing it. And I have seen liens placed on executives and corporations, and that is not a fun phone call to get on an afternoon when your CFO calls and said they just liened my bank account. What the is going on? It happens. It's a real thing. So just beware. Work with us. We'll try and keep you out of these sinkholes, as I like to refer to them. But it's real. It's real out there.
It's wild. That's the only way I can really describe it. It's wild, right? And so
Yeah.
part of the things that and working with the NSA group for this webinar, I think we had sent over a link that we did for the anniversary of the Boston Tea Party. And it's so funny that we've gone from, taxation on tea to now we've got 14,000 different tax jurisdictions, and it's just getting more and more complex. So once we, uncover where we have nexus, then we need to figure out, how do we get registered? So we get registered in a state, but what happens if we get registered in a state like Alabama and Georgia, for example? Services are taxable in one state, not taxable in another. So then we have to start looking at, kind of what's below the sea level here, using this slide as kind of a representation of there's more behind the scenes than what we see that's clear to us. And so let's get registered in the state. We'll charge sales tax, but then we start looking at product taxabilities, and then we've got implantable medical devices. Those are taxable in some states, not taxable in another. In some states, they're taxed at a 3% or a partial tax rate than what the full state tax rate is. And then we start looking at, a Snickers bar and a Twix. One has flour, one doesn't. The one with flour is considered a food, so it's not taxable. Then we've got, packaged foods. Like, there's so many types of complexities that go into product taxabilities. And then we got to look at jurisdiction assignments and, kind of forecasting. If we can go ahead and go over to the next slide here, I can kind of talk to it. But here's a perfect example of a location in Colorado. So if there's anybody that's registered in Colorado, somebody that's looking to get registered in Colorado, here's a perfect example where Colorado really takes confusing, and they say, hold this and watch me, because I'm going to make it all that much more confusing. Because we're in a situation now within Colorado where even the state or even a same zip code can have 4 or 5 different tax rates. Because what happens when the states went and the states went and drew these kind of imaginary lines of jurisdictions, our system looks at a lat long, so we're able to get that rooftop accuracy. But if you're just looking at the zip code or the zip code +4, that could be a difference of 6% or 8.5% in some cases in Colorado, because then you've got the city tax of Denver, you've got like a transit tax. And so those are the even more complexities that we have to kind of be aware of. So once we do get registered in states, it's not just a state flat, 6% tax rate or 8.5%. Then you have to start looking at, the transit fees or the shipping fees that Brian was talking about. Then you have to look at, well, are they at a North Drive or South Drive? Because if they're North Drive, then it's going to have the city tax, and if they're South Drive, it's not going to have the city tax, but it's got the transit tax. So those are all things to take into consideration. And when we start having conversations with clients about this, we start to realize that it's a little bit more complex for the accounting and finance teams that are actually doing this research to figure out what the appropriate tax rate should be. And so that's something to take into consideration from when we're looking at a tax calculation of just how complex it can be. But now we got to start taking in consideration exemption certificates. And so if we get registered in a state, or if you're not registered in a state, even though you've exceeded the nexus threshold, to the state's eyes, even if you know that customer's tax exempt, if we don't have that exemption certificate to prove it, the state's going to get you for that one. Okay. So, what the exemption certificates do, or the importance of having exemption certificates, certainly minimizes audit risk, reduces our exposure. Um, but things that we have to take into consideration too is, we collect the certificate, great, what happens when we collect it? Or do we have somebody that's going through and validating that certificate to make sure that it's got the appropriate seller information, that it's signed correctly, that it's dated correctly, that it's the right exemption certificate? New York, for example, has like 30 different exemption certificate forms. What happens if the customer sends you a tax ID form and not an exemption certificate form? And these are things that are going on in audits when they ask for a sample size of exemption certificates. And if you don't have that exemption certificate, the states are going to hit you for penalties and interest. So it's really important to, when we're looking at, the 5 key areas to make sure that we're staying tax compliant. One of them is making sure that we are uh, managing these exemption certificates correctly, that we're storing them, that we have them on file, that we can track them. So if the state ever asks for it, we can provide that. And then something that has been coming up increasingly here is, you have an exemption certificate from a client that you got, 6, 7, 8 years ago. While that document may not expire, how are we? What's the internal process that we have to make sure that we have a valid certificate, 5 years down the road? Because there's been a lot of acquisitions going on. There's been a lot of entity changes, and so if there's been an acquisition and you're now still giving that customer tax exempt benefits, or not charging them sales tax, and they've changed ownership, that's going to come up in an audit. So, how do we limit our liabilities and our risk by maintaining and staying on top of our exemption certificates? And here's a case study that we have done through here at Avalara. And a case study for a manufacturer in New York. 99% of the sales are to resellers or OEMs, so there's no tax. Like, right, we don't have to worry about sales tax. We got an exemption certificate. Uh, but what we have found out was that the previous exemption certificate count for this particular manufacturer in New York was under 75. But what they needed to have was, one for every customer, one for every ship to, that type of thing. And it went up to over 1,000 certificates that they were managing. So, how is that one person that was managing 75 exemption certificates going to now manage over 1,000 certificates? In a similar case study for a reseller who's selling directly to end users and drop shipments as part of their model, Wayfair grew their nexus outside of the physical headquarters to most U.S. states. And like I mentioned, of the 50 states, 4 of them don't charge sales tax. Between those additional 46 states, there's about 14,000 tax jurisdictions. So, how are we making sure that we have exemption certificates, the appropriate amount of exemption certificates, so if in the event there ever was an audit, we would be able to have that supporting information? So just take that into consideration as we're looking at ways to limit our exposure. One of the solutions that we have here at Avalara is our exemption certificate management solution. I'll call it ECM because I say that all day, every day, and it just hurts my mouth when I say exemption certificate management. But we have a very user-friendly solution that can operate as a standalone. So if we decide that we don't want to integrate the full, Avatax suite, while there are benefits to automate the entire process, you do have the ability to have a solution that can operate as a standalone. That's got a very clean front end. Customer client experience of being able to request certificates directly from the solution, be able to validate and verify the certificates directly through the solution, being able to monitor which certificates for which clients are missing, which ones are expiring, that type of solution. So if you're interested in seeing that solution or learning more about the solution, please do reach out. We can certainly talk about how we can kind of automate the process of managing the exemption certificates. And so, kind of tying it all together here, we talked about the importance of making sure we're registered, understanding where we have nexus. Once we understand where we have nexus, we get registered. Then we do the tax calculations. How are we doing the tax research on product taxabilities? All of that logic lives within our tax engine. So if we're shipping a prepackaged food items to a state like Georgia versus a state like Ohio, if there's different taxabilities for those products, our system has that logic built into it. But how do we manage the exemption certificate? So once we go through that entire process, now we've got to file these returns. Okay, so that's where it's important. If we go to the next slide here, kind of show you some best practices to make sure that we're filing appropriately and on time. Different states, once you get registered, they'll have different filing frequencies. Some will be monthly, some will be quarterly, some could be annually. And I think that's all kind of determined based off of sales revenue, sales volumes into the states, taxable sales into the state. So certainly, I believe those go into what's determining the filing frequency. But then once we do that, we've got filing deadlines. You don't want to miss a deadline. Some states it's the 15th, some states it's the 20th, some states it's the last day of the month. Some states offer early filing discounts if you file before the 15th. So those are things to definitely take into consideration when we are keeping up with our filings and our returns. And then we also want to make sure that we have all of the right data. So if we go to the next slide here, yeah, we've got to pull the sales from our point of sale solutions, our point of sale systems. We've got to pull the e-commerce solutions that are going through our website. A lot of I've seen a big trend in distribution space where e-commerce has been a big adding point for clients. So are we pulling in the data from the point of sale? Are we pulling in the e-commerce? Are we pulling in those the marketplace facilitator sales? Are we pulling it from the ERP system? How are we reporting that to the state? So these are all things that we need to take into consideration when we're filing these returns, which we have a service that can do the filings as well. But as we do get registered and as we do start expanding our nexus, these are just some best practice thoughts to keep in mind for the filing and the remittance of these returns. And so, kind of bringing it all home here, when we look at the Avalara compliance suite, I think, if it's not the orange that gives us away, I think most people are just assume that Avalara is that tax calculation company. Well, that is our bread and butter. That is what we were founded on 20 years ago for being that tax determination solution. Our core products have expanded to the exemption certificate management, the tax returns and reporting, and then we've seen an increase in the e-invoicing and live reporting come up as well. But other supporting products that we do have are licensing and registrations. We have a tax research tool that you can leverage. I think we can get a 2-week free trial on that if anybody's interested in that. Basically, this would be a good solution for you if you're constantly on Google typing in, what's the taxability of this product in this state? Is there a tax-free holiday? Is this considered taxable or not? So these are all things that we've added to really kind of solidify our place as being the leader in the space on being able to provide different solutions. Increasingly as well as our cross borders, our internationals, our VAT tax, HS classification codes is another big selling piece that's been or big ask of our clients of how are we able to not just focus on the U.S. tax compliance, but how do we solve tax globally? So we've increased those products and service offerings that we have, so that we can really be that one stop solution for all things tax related. And then we've got our integrations with various ERPs and accountings, software, CRMs, e-commerce, marketplace, extractors. So if we're selling out of Amazon or selling to eBay or we have extractors that we can easily pull that data in for the filings and the returns portion of it. And then obviously we've got additional professional services, risk assessments. We've got two different options for risk assessments. We've got a premium risk assessment, which will basically go 5 years back, make the determination of when and where you triggered Nexus, what would be the penalties and interest if we did get registered into the state? Do we need to do a voluntary disclosure? Those are types of things that we can discuss if you're interested in having an additional conversation about our premium risk assessment. But I think for everybody that's joining the call here through our partnership with NSA, I believe we're offering a free standard risk assessment. So this is where I'll say, get your phones out, take a picture of the barcode here if that's something that you're interested in taking advantage of. The standard risk assessment, to just kind of lay out the difference between the premium and the standard. The free risk assessment goes 1 year back. So that 5-year look back could be very important, especially if we do have significant Nexus exposure through transactions or sales. Dollar revenue wise, and we're concerned that we may not have the exemption certificates or what have you. So certainly the premium risk assessment goes back 5 years, but if we're interested in just getting a level set on where we might have potential Nexus exposure now, definitely scan this QR code. Let's get that risk assessment set up. And then I would also encourage, before we do that, let's just jump on a call to kind of talk about where you're at, right? Because I definitely like working with NSA. I like working with mutual clients. I like to just really take a full big picture approach and put together an approach that's going to not have any surprises that potentially would come up. Someone once told me surprises are only good on birthdays and Christmas, and so want to make sure that as we go through the evaluation process, as we start talking about solutions, we're able to present a full suite of solutions that are needed by the company, that have value, and that would certainly be something to help eliminate and kind of automate and make things easier for y'all. So that's really everything that I think we wanted to go over today. Certainly, if you're interested in scheduling conversations, reach out to anybody at NSA. They can make an introduction, or feel free to reach out to me directly. I think my contact information will be communicated in the email. So certainly look forward to having any conversations if anybody's interested in that.
Yeah, so Andy, really appreciate the presentation along with Brian. I know he had to go. So I'd really like to thank Avalara for offering that free tax assessment, or risk assessment rather. I don't know why a distributor wouldn't choose to do that, right? So it really shows you, where you've got potential issues, and I would encourage everybody here to take advantage of that. Here's the contact information for the Avalara team. I would ask if we can maybe bring up the slide that does have the QR code on it, just in case anyone hasn't had a chance to go ahead and scan that. There we are. And I do have a couple of quick questions, and I would ask that anybody else that has questions, please enter it into the chat. I know we've got about 5 minutes left in the presentation, but I've got a couple. So one question I have, and you touched on it, Andy, a little bit, is there's two areas where I see all of a sudden a distributor getting very deep into tax needs and so forth. You mentioned the complexity of Nexus and other things, but e-commerce certainly all of a sudden opens up a distributor to tax ramifications wherever that potential customer is coming from, right? We may not even know where they're all going to be coming from through e-com, and all of a sudden that just blows up the complexity of our tax situation. That, and then the other thing that we see is a lot of consolidation in the distribution space, right? So when a company makes an acquisition, it opens up, possibly new states, even, in the, other places in North America like Canada and so forth. So can you talk to those two pieces just very briefly? And I would ask anybody else, please enter your questions into the chat.
Yeah, no, Brian, I appreciate it. From an e-commerce perspective, I mean, that's exactly right. I mean, a lot of the e-commerce sites are, specifically locked down for, we got to do some type of verification process. Do we get an exemption certificate? We have to onboard the client before we give them login credentials. But when we have just a end user type accessible e-commerce website, I've seen it where a company went being 100% tax exempt. Then they opened up an e-commerce site, and they weren't registered in any states, and they triggered Nexus in just about every state. And these direct to consumer sales through their e-commerce site were not collecting sales tax because they weren't registered in it. And so that's where, voluntary disclosure agreements are really going to be important, because if we go through an audit in a state and they find out that you've been, let's say you hit Nexus in their state 4 or 5 years ago, and you haven't been collecting any sales tax on those e-commerce sites, then yes, that's going to be a major red flag, a moment that could potentially come up is, we should have been collecting sales tax, but because we didn't know about the Nexus laws where we should have been registered, we just didn't think about it. So that's one piece that I can really kind of speak to that has come up in the e-commerce side of business. And like I told you, I've been seeing it a lot more in communications, and it sounds like it's something that you guys have been seeing at NSA as well. And then I think the second piece was about the
acquisitions, right?
acquisition.
Consolidation in the industry.
Yeah. So, if we're acquiring a company and we keep it under the same EIN, then yes, that's going to increase your Nexus exposure through that acquisition. If you set it up under a separate EIN, again, going back to the disclaimer, don't take any of this to the bank for perspective of legal advice. But if we have separate EINs, then yes, that could kind of, in theory, limit your Nexus exposure in a way to where if you acquire a company that's registered in 15 states, but you want to separate them from your current EIN that's only registered in 3 states, that's certainly one way that you could go about it. But most places, when they go through acquisitions, they tend to just kind of put everybody under the same account or the same entity. And then certainly that kind of adds some complexity to making sure that we're registered in all those states. And then it kind of goes back to what we talked about during the presentation of, you have one person doing it because you've only got Nexus in 3 or 4 states, but that acquisition triggered Nexus or kind of took your Nexus from 3 states to 15 states. How do we manage that effectively and efficiently? And those are the areas that we've really been able to help clients automate that process for them.
Very good. Well, thank you for that. I don't see any other questions. I would like to thank everybody that took the time out today to attend today's webinar. I'd like to thank the Avalara team as well, and especially the special offer that we have out there for the risk assessment. I would certainly encourage everybody to take that. We will be sending out a recording of this session. Typically, that goes out within 24 hours or so of today's webinar. But with that, I think we have a wrap. And again, thank you, Avalara. Thank you for folks that chose to attend today's session.
Yeah. Thanks, everybody.
Thank you, guys. Bye-bye.